October 2001. America's seventh largest company declared bankruptcy. 63 billion vanished. Thousands of employees lost everything. Wall Street was stunned, not because it happened, but because nobody could understand why. This is the story of Enron, an American energy company based in Houston, Texas, a company that sold almost nothing, yet made billions, then collapsed while everyone was still applauding. Imagine a company that got rich simply by transporting gas through pipelines. Not the explosive kind, but the boring kind. That was Enron, founded in 1980. Initially, it was just a regular gas pipeline company in Houston, born from a merger that nobody cared about except a few tax lawyers and accountants. Then Kenneth Lay appeared with a PhD in economics, tan skin, and a bold idea to deregulate the energy market. If the government stopped controlling prices, Enron could transform from a service company into an energy trader. Suddenly, gas was not just pumped through pipes, but also bought and sold. Speculation was like trading stocks on Wall Street, except it smelled worse. Enter Jeffrey Skilling, an eloquent McKinsey consultant who had absolute faith in the market, spreadsheets, and himself. Skilling promoted Enron is more than a pipeline company. We are a tech company. We don't sell energy. We sell the future of energy. Wall Street went crazy. The real breakthrough came when Enron launched Enron Online, a digital trading platform for energy contracts. Now, buying and selling gas was as easy as ordering pizza. Just press a button and millions of dollars moved. Suddenly, Enron was no longer an ordinary gas company at all. It became Silicon Valley in a cowboy hat. The media was obsessed. Fortune magazine called Enron the most innovative company in America for 6 years straight. Inside Enron headquarters, the tension was electric. Skilling told employees, "You are the smartest people in this room," implying if you don't meet targets, you'll be fired. The bonuses were huge. Backstabbing happened every day. And each quarter was a survival battle to impress investors. You closed 5 deals, cut $20 million in costs, doubled quarterly revenue, and signed a margin guarantee contract all the way to 2009. Yes, sir, all targets were impressively met. If this were a normal company, Enron saw itself as a market maker, a tech innovator, the intellectual hub of the new era. From the outside, Enron looked like the future personified. But if someone asked what they actually did, you'd get a shrug, a whiteboard, and 40 minutes of confusing jargon. Yet the stock price kept rising. So nobody asked again. And while the spotlight grew brighter, behind the scenes, something dangerous was quietly starting to crack. By the late 1990s, Enron had become a legend. The stock price soared from $7.97 to over $90 in 2000. That's an increase of over 1,000% in just 3 years. If you bought Enron stock instead of groceries, you would have been a genius. The media called it a miracle, while the executives called it a party. But after the champagne and extravagant presentations, the numbers began to not add up. Enron had promised too much. Continuous growth, huge profits. No quarter showed a loss. But the energy market isn't TikTok. It can't boom every week. So they changed the rules. They applied mark-to-market accounting. Or jokingly, we're counting eggs that haven't hatched and might not even be chickens yet. Here's how it worked. Enron would sign a 10-year energy contract. Instead of waiting for real cash to flow in, they recorded the entire expected profit from all 10 years immediately. You can't do that, you might say. Yes, we can. We are doing it, they replied. So on paper, Enron looked like a cash printing machine, but in reality, many deals barely broke even. Some hadn't even started yet. Others were based on forecasts, making astrology seem conservative. Inside, it was chaotic. But as long as the image held, no one dared blink. And when the numbers stopped matching, Andrew Fastow, Enron's foe, stepped in. And his main job was, politely put, storytelling by the numbers. Fastow created dozens of shell companies, called Special Purpose Entities, or SP. On paper, they were separate from Enron. But in reality, everything was controlled by Enron. Here's the trick. Enron sold its worst assets. Loss-making deals, depreciating assets, to these shell companies. On paper, it looked like Enron was offloading risk and collecting cash. But in reality, Enron was financing Both sides of the transaction. Simply put, it was like selling your broken car to a dog and giving it your credit card to pay. Then telling your wife, look, I sold the car. And Fastow was very creative in naming these shell companies, LJM1, LJM2, Raptor, because nothing sounds more legal than computer-generated names. I'm not breaking the law. I'm just being creative. While Fastow was spinning debt like juggling fire, Enron's top executives were cashing out of the company, collecting millions in bonuses, stock options, mansions, and private jets. While Fastow was spinning debt like juggling fire, Enron's top executives were cashing out of the company. They collected millions in bonuses, stock options, mansions, and private jets. Meanwhile, ordinary employees were encouraged to invest their entire savings and retirement funds into Enron stock. Their retirement plans became little more than a prayer to Enron. And ironically, most Wall Street analysts continued to praise Enron, recommending it as a buy. Many of them worked for firms doing business directly with Enron. For example, Merrill Lynch earned millions from managing Enron stock offerings, yet still publicly praised its financial reports. Objectively, they could ignore revenue, but not the truth. The truth was buried under layers of jargon and complex spreadsheets created by people treating ethics like software. Install it or uninstall it at will. Ethics were optional. The system was convoluted. It was easy to pretend not to see. Enron encouraged that ambiguity. Their unspoken motto was probably, if you can't explain it, you're doing it right. By 2001, Enron's image was steel strong, until finally someone dared to ask, wait, where's the real money? August 2001 at Enron Tower. Jeffrey Skilling, CEO of America's hottest company, walked into his office, placed his resignation letter on the desk, and left. No scandal, no press conference. Just a simple, I'm leaving. I'm tired of being the genius. He said he wanted to spend more time with his family. I mean, with his millions of dollars. A red flag the size of Texas. Also that month, the SEC opened an investigation into Enron's off-balance sheet entities. In corporate speak, that meant, we smell smoke even if we don't see fire. And so Kenneth Lay, the gas-peddling alchemist, Enron's founder, returned as soy, grinning like your grandpa. After accidentally deleting your home, he said, hello everyone. Just another Monday. Business as usual. But inside the company, not everyone swallowed that. One of them was Sharon Watkins, VP, who began noticing that the numbers didn't match. She wrote a memo directly to Kenneth Lay. With a blunt warning. I am extremely concerned that we will collapse in a wave of accounting scandals. An internal investigation was launched, but instead of raising the alarm, management treated it as a public relations issue. And their conclusion: we just need better communication, not that we are committing fraud. And then the cracks began to show more clearly. A few persistent journalists and analysts started to sniff something out. They asked simple questions that made the whole system tremble. Why was Enron's operation so convoluted? They began asking, who actually owns these mysterious off-book companies? And why did Enron's financial statements look like someone had just hammered them? Enron responded with a PowerPoint slide, full of trendy jargon and a middle finger. We are a platform revolutionizing energy arbitrage, a groundbreaking approach. We leverage volatility differences, assumptions in market-to-market derivatives, within structured energy swaps. Yes, meaning nobody understands it, not even them. October 2001. The final mask fell. Enron publicly admitted accounting errors. In corporate speak, that meant we cooked the books so hard they caught fire. It turned out $586 million in profits were just an illusion. It wasn't a typo. It was the terminal tumor of financial fraud. At this point, investors finally woke up. Selling everything, stocks, sofas, even the dog. Enron stock plummeted from nearly $90 in August to under $1 by the end of November. In just 4 months, Enron evaporated and out of its value. The entire office was in chaos, phones ringing off the hook, directors in hiding, employees staring at stock tickers, as if watching their lives melt away. Then on October 2nd, 2001, Enron officially filed for bankruptcy. This was not just a business failure. It was a financial disaster. $63 billion in assets vanished, marking the largest corporate collapse in U.S. history at the time. Thousands of employees who had invested their entire into Enron stock lost everything. Empty accounts, shattered trust. I had saved for 20 years. Invested all my bonuses into the company. I gave them everything. I trusted them completely. I am not a crook. Sure, but he withdrew $70 million before resigning. And Fasto pocketed from the very financial tricks he had created. Netwise, he sold millions of shares, while still telling his employees to hold on to stock. Believe in Enron. The result? Employees received layoff notices, while executives bought coastal mansions. But wait, shouldn't someone have been checking the books? I mean, the auditors, right? And that's when Arthur Andersen showed up. They used to be one of the big 5 accounting firms. Before becoming the big 4, Arthur Andersen should have been the financial watchdog, the sober referee at the party. Instead, they were the ones spiking the punch. Arthur Andersen didn't just audit Enron. They made a fortune consulting for Enron, teaching them how to optimize the books. Yes, the very people hired to give an objective assessment of Enron's books were also advising Enron on how to commit fraud. A massive conflict of interest. But this was the early 2000s. No one cared. Then whistleblowers appeared. Investigators started closing in. Arthur Andersen didn't open the audit books. They destroyed everything. Thousands of documents shredded. Boxes full of financial records, memos and backup archives. All fed into the shredder in a frenzy. This machine was even slower than our HR department. Or should we stop? Can't do that. We have 12 years of fraud to erase, and only 1 lunch break to do it. Do you want me to fix the shredder? Oh, lucky. There's an intern here. Start eating the paper. We'll need all hands and mouths. The accounting firm claimed they were just following document retention policy. The prosecutors weren't fooled. As a result, Arthur Andersen was convicted of obstructing justice. Their public company audit license was revoked immediately. And overnight, 85,000 employees lost their jobs. A company nearly a century old collapsed in one night. Poof, gone. Not because they committed fraud, but because they helped cover it up. And they weren't alone. J.P. Morgan, Citigroup, Maryland, all funded. Enron's off-book deals. Building lies, collecting fees, then slipping away. No company faced criminal charges. But all were fined hundreds of millions of dollars. Luckily, Enron's leadership didn't escape that easily. Skilling, Lay were prosecuted in 2004. Skilling, the executives, were charged. Skilling sentenced to 24 years in prison. Kenneth Lay suffered a heart attack and died before serving time. One day, Andrew Fastow pled guilty and got 6 years. The U.S. Congress rushed to pass new laws, the Sarbanes-Oxley Act, or as finance folks jokingly call it, the Please Don't Lie Act. From now on, CEOs must certify numbers. Auditors must pretend to be honest. A belated effort. But here's the real twist. This story isn't just about Enron. It's a story about trust, about illusions and what happens when the whole world wants to believe in something so badly that they stop asking questions. For 16 years, Enron sold the future and everyone bought in. But when the lights came on, the building was empty, the numbers were fake, and the smartest people in the room disappeared, as someone once said. A lie can travel halfway around the world, while the truth is still putting on its shoes.